If a $2,000 emergency would still derail your year, 2026 is not the year to ignore that, because here's what's quietly happening. Wages haven't fully caught up with affordability. Credit card APRs are still hovering near historic highs. The Federal Reserve is shifting rates again, and a major tax overhaul just changed the rules. Nearly 1 in 3 Americans believe their finances will worsen in 2026, the highest level of pessimism in years. At the same time, most people are setting financial resolutions. But here's the real divide heading into this year. Some people will drift and hope conditions improve. Others will position early and reduce risk before it shows up on a statement. This is about being in the second group. And if you implement even 3 of these moves, 2026 will feel very different. 1. Understand the new tax rules. Before December, tax planning is no longer something you do in April. It's something you design before year-end. There's a new tax overhaul in effect, and it creates real opportunities, but only for people who prepare. If you earn tips or overtime, there's now a provision allowing workers to deduct up to $25,000 in tip income that's meaningful. But here's what most people will miss. You must track and document your earnings carefully to qualify. If you work in hospitality, delivery, gig work, or any tip-heavy role, sloppy record-keeping could cost you thousands. Documentation equals deduction. The same applies to overtime income. If you're working extra hours in 2026, don't assume payroll handles everything cleanly. Keep your own records. The difference between organized and unorganized here could easily be a 4-figure swing on your tax bill. That's not minor, that's positioning. If you're 65 or older, there's an enhanced senior deduction starting in 2025. $6,000 additional deduction, single. $12,000 per couple, joint. However, it phases out above. $75,000 modified adjusted gross income, single. $150,000, joint. That means you need to know your modified adjusted gross income, MAGI, not just your salary. Start with your AGI, line 11 on Form 1040, then account for adjustments. This isn't guesswork. A few $1,000s in additional deductions can materially change your tax outcome. And here's the uncomfortable truth. Most people will learn about these rules too late. Don't be most people. Number 2, redesign your budget. Don't just rewrite it. Most budgets fail by March, not because people lack discipline, because they rely on it. If your plan depends on daily motivation, it's fragile. In 2026, budgeting is shifting from willpower to system design. A solid baseline framework is still the 50/30/20 model. 50% essentials, 30% lifestyle, 20% goals, debt, savings, investing. But the upgrade is automation. Automatic transfers into savings, payroll deductions into retirement, category caps inside your banking app, alerts when spending trends spike. You shouldn't have to remember to do the right thing. Your system should do it for you. Infrastructure beats motivation, and motivation always fades. Number 3, eliminate high-interest credit card drag. If you're carrying balances at 20 to 25% APR, that's not just debt, that's financial gravity. A $5,000 balance at 24% interest costs, roughly $1,200 per year if unpaid. That's money working against you every single day. 2 structured approaches, avalanche method * list debts by highest APR, * pay minimums on all. Aggressively attack the highest rate first, mathematically optimal. Snowball method, pay off the smallest balance first. Build momentum, increase motivation. Psychologically powerful, both work. The mistake is doing neither, and here's something most people don't want to hear. If you're paying 24% interest, investing can wait. Eliminate the drag first, then accelerate. Number 4, use 0% balance transfers. Strategically, if your credit profile allows it, a 0% balance transfer card can pause interest for up to 21 months. That's breathing room, but only if you stop adding new debt, have a clear payoff timeline, understand transfer fees, also call your current issuer, ask for a lower APR. It sounds simple, but many people never ask, and many issuers would rather reduce your rate slightly than lose your balance entirely. One phone call could lower your interest several percentage points. Never assume your rate is fixed. Number 5, lock in savings rates before they fall. The Federal Reserve has already cut rates, and further cuts are possible. That likely means savings yields will decline. Right now, many online banks are offering around 4% APY. Here's the math. $10,000 at 0.5% equals $50 per year. $10,000 at 4% equals $400 per year. That's an 8 times difference. For moving money, not earning more, not budgeting harder, just positioning. If rates continue falling, those yields will shrink. Opening a high-yield savings account or locking in a CD now could protect your returns. Small optimizations compound. Number 6. Build or rebuild your emergency fund. Nearly half of Americans can't cover a $2,000 emergency without borrowing. That's vulnerability. Start with $1,000 baseline emergency fund, then aim for 3 to 6 months of expenses. Even $200 per month builds $2,400 per year. Emergency funds aren't exciting, they're stabilizers, and stability changes behavior. When you have a cushion, you negotiate differently. You avoid panic borrowing, you make clearer decisions. The difference between $0 saved and $2,000 saved isn't just money, it's peace. Number 7. Capture your full employer match. If you have a 401k with matching contributions, this is non-negotiable. Most employers match 3 to 6% of salary. If you earn $70,000 and your employer matches 5%, that's $3,500 per year. That's guaranteed return. If you're not contributing enough to receive the full match, you're declining compensation. Set automatic payroll deductions to at least hit that threshold. Then, if possible, increase contributions gradually. Small increases create massive compounding over decades. This is one of the highest leverage moves available to employees. Number 8. Consider a year-end 401k boost before year-end. Check whether you can increase contributions. Why it matters. 401k contributions reduce taxable income. That means you strengthen retirement and potentially reduce your tax bill. Few financial moves accomplish both simultaneously. Even a short-term contribution bump in Q4 can have a measurable impact. Zoom out. 2026 is about positioning. Here's the environment we're entering: affordability pressure, tax restructuring, rate shifts, elevated credit costs. This isn't a year for drifting, it's a year for reducing fragility. Fragility shows up when debt compounds faster than income, savings earns less than inflation, taxes catch you unprepared. Emergencies force borrowing. Resilience shows up when systems run automatically, high interest drag is eliminated, employer benefits are maximized, liquidity is available when needed. The gap in 2026 won't be between lucky and unlucky. It will be between prepared and unprepared. Start with these 3 moves. If you're overwhelmed, simplify. Start here. 1. Contribute enough to your 401k to receive the full employer match. 2. Move your emergency savings into a competitive high-yield account. 3. Create a written payoff plan for high-interest debt. Those 3 actions alone can increase effective income, reduce financial drag, strengthen stability. That's leverage, and leverage compounds. 5 years from now, the people who feel secure won't be the ones who made dramatic changes overnight. They'll be the ones who made structured decisions early. If you want practical system-based financial strategies, no hype, no shortcuts, subscribe. Every week, we break down real financial shifts and show you how to position yourself before they hit your wallet. Because in a changing economy, awareness isn't optional, it's an advantage.